Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 252nd podcast VideoCast for the week ending August 14th, 2024. And we're doing this a little bit early. Just got called in to do Varney & Company tomorrow morning on Thursday, 10 a.m. Then I've got WOR Radio, which is the largest political radio station in New York City, with Larry Menti. Excited to talk to him at 11:10. Then I got BBC at 5:30. Then I've got Yahoo on Friday at 3:30. So busy couple of days. Wanted to get this in. And then, we'll make the announcement in just a minute. But family first, want to congratulate Mimi and Annabelle. Crushed it at the 2024 Eastern Zone Championships, both moving into a higher age level, and got personal bests in pretty much all their races. And that was at the Hampton Aquaplex in Hampton, Virginia. Annabelle was the 50-meter butterfly champion. Annabelle dropped 19 seconds in her 400-meter free. Coach Kyle cheered for her every single lap, and she had him come on the podium with her to celebrate and wear a matching tutu. Okay, I guess we'll have a picture of that. And that was that. So let's see if we've got that. There's Annabelle with her medal. That's with the super ducky there. And then there's Annabelle on the podium. Get used to it, kiddo. There's Mimi and Annabelle. This is probably my favorite picture. Probably going to make it my phone wallpaper. That's Caitlin with the girls. I think I showed that one last week. That's one of my favorites. And then Annabelle again. And they're the matching tutus. So there you go. Next week, we have a special post-Alibaba earnings call podcast. Brendan Ahern will be on with us. I'm going to do a question and answer. Brendan lives out in Connecticut near me. We got to meet up this week. His son was playing in a super high level golf tournament, and Brendan runs the $5 billion China technology ETF KWEB. So he really knows this stuff flat. He's a specialist, and I'm excited to have him on and also get out and play some golf in the next couple of weeks as well. So look forward to that next week on the podcast 253. Want to thank Christian Dagger and Preston Mizell for having me on Varney & Company last Thursday. Thanks to Stu Varney as well. We're going to listen in here.
The markets, it is a rally. Dow's up 476. Nasdaq's up 219. Of course, look, we've been here before. Market straight up, and then in the afternoon it goes straight down. I don't know how it's going to close, but right now it's up. Tom Hayes joins us to look at the market this morning. Is the Fed, in your opinion, is the Fed doing the right thing, leaving rates exactly where they are until September?
They're not doing the right thing, Stu, but they're going to get away with it. And that's because, as we saw this morning, as it relates to the economy, the rumors of my demise are greatly exaggerated. So we saw initial jobless claims come in lower than expected. They're going to get away with it. The problem is, why you're seeing all this volatility is Bank of Japan bailed out the West while we were fighting inflation. They were the global liquidity provider, buying bonds globally, buying equities globally. And when they needed to hike to fight inflation, we didn't come to their rescue. When they hiked last week, the Fed should have been cutting and we wouldn't see this volatility. So BOJ had to back off until September when the Fed's going to cut. And now we've got a high chance, 80-some-odd% chance of a 50 basis percent cut in September.
And the market's doing well.
The market's doing great.
There you go. I know you like two stocks in particular, and I'm interested in this. Disney. Disney's all the way down to $84 a share. I mean, that's a dip and a half.
Disney, you can't give away right now. And I'll tell you, I look at Disney. Disney's the sum of the parts, okay? So you have the parks and the experiences. People are worried that the parks are slowing down for the next couple of quarters. They're going to do $10 billion of EBIT, which implies $80 a share in value for the parks and experiences. That means Disney Plus is worth zero. ESPN is worth zero. Theatrical Productions is worth zero. You saw Deadpool, it's going to be a $1 billion franchise. Inside Out 2, $1 billion franchise. It's attributed zero. So they've got 153 million subscribers. Netflix has 277 million. They get $250 billion valuation. This business gets zero. So we think between the parks and the streaming over time, the streaming can do 10 to 15 billion of EBIT, which implies $150 to $190 a share over the next 3 to 5 years. And you can't give it away today.
If you bought it for 84, you'd be satisfied with just $100 in exactly 6 or 7 months.
Take the long view here.
One last one. and we've often covered this. Generac, the generator people.
Fantastic business. They got in trouble from 2001 because they overstocked during COVID. They spent 8 quarters working through that destock cycle. Now they're in the restock cycle. Residential was up 8%, commercial was up 10%. They beat and raised for this quarter. So we like this business. The grid is unstable, and we're entering hurricane season as rates go down, so people are going to be able to finance them more easily.
Isn't that a good case? Where's it go? Well, 137 now. Where's it going?
This thing is probably over time going to work towards 200. Give it a 12, 24, 36 months.
12, 24, 30, that's okay. An accordion of time frame.
I'll tell you, they've got 6.25% penetration for their total addressable market. This has tremendous opportunity moving forward. So I want to be conservative here, but our expectations are much higher than that.
Got it. Tom Hayes, thanks very much for joining us.
Thanks for having me.
You'll be back if you're not careful.
I appreciate it.
All right. Lauren's looking at...
And we're back. And then I want to thank Jeff Cohen and Trinity Chavez for having me on NYSE TV from the New York Stock Exchange yesterday when the PPI inflation numbers came out. We'll tune in here.
Open right now, and joining me to talk more about this eventful day is Thomas Hayes. He is the chairman and managing partner and managing member at Great Hill Capital. Good morning.
Good morning, Trinity. Thanks for having me today.
Absolutely. So let's lead things off with some news that just came in about an hour ago, the release of July wholesale price data. What are you taking away from the fresh data?
Well, this was phenomenal for the markets, and the markets like it. Basically, it came in at 2.2% versus 2.3% expectations year on year, and month on month, 10 basis points versus 20 basis points expectations. The interesting thing about this report, Trinity, is that 70% of the inflation was energy-based, energy products. And the other thing that we saw, which is a change from recent history, is that goods were hotter than services. The last few months, services have been very, very sticky, and goods have been in decline. So it's nice to see services come down, and the market certainly likes it. Now, the key, Trinity, is the impact that it has on expectations for rate cuts, which is what has the markets waiting with bated breath.
So more inflation data arrives tomorrow when the Bureau of Labor Statistics releases consumer price data for July. So what are you pricing out here?
Yeah, I think it's expected to bump up a little bit from, it was negative 0.1% last month for the month on month. This month it's expected to be plus 0.2% and 3% year on year. The key, though, will be, is this trend correct? And the trend that I'm talking about is expectations for probabilities of Fed cuts in September. Right now, as of this morning, just a few minutes ago, we have a 55% chance of a 50 basis point cut in September and a 45% chance of a 25 basis point cut. 0% chance of no cuts, which is a big change from just a couple of months ago. And then as of December, because of these inflation numbers that came in this morning, we have a 100% chance of 75 basis points by December, and we have 78% chance of 100 basis points by December. And the market likes it. The market's up. They just want to see confirmation tomorrow. So if you see a little uncertainty midday, just know the market's waiting for CPI tomorrow, Trinity.
Okay, and the CME FedWatch tool is forecasting 100% chance of rate cut next month. But it's also showing, it's also showing, though, a dead heat when it comes to traders expecting a 25 basis point cut or 50 basis point cut. So what do you believe that we'll see next month as this all goes down?
Yeah, it's a coin flip. The key, more than whether it's 25 or 50, is that they get started, because they can always speed up or slow down. The market has been waiting with bated breath for the Fed to finally move. We're very, very restrictive, over 200 basis points above inflation. So they have to get started, and they have to adjust as they go along and see the data. So I think that's less important for equities than knowing that they're in the game and they're not going to be too rigid in being data dependent. They have to move before we hit 2%, because if they move by the time we hit 2%, we're already in deflation, and that's a much harder problem to solve.
And from your vantage point, do you think that the Fed waited too long to begin cutting rates?
Yes, but they'll get away with it.
Well, I mean, that was a short and sweet answer. And oh, go ahead.
Yeah, they certainly waited too long, but they will get away with it so long as they move in September. They have the Jackson Hole meeting as an opportunity to convey some dovishness and to signal for September, which should hold things together until they finally start the cutting process. Just in the nick of time is really what it's going to come down to.
And, we've also seen a lot of heightened amount of market volatility over the past week. So what are you advising investors to do in the near term amid a flurry of economic headlines?
Yeah, so it's definitely created some bargain opportunities. I think we're going to hold up here into the first cut. We may see some volatility in the fall after that first cut and before the election. But on balance, look, earnings are strong, 10.8% year on year, with 78% of the companies reporting. That compares to analysts expected 8.9% earnings growth. To have 10.8% is really, really good for Q2. If you look at the GDP now, we're still growing at 2.9% GDP growth. It's a big deal. And then estimates for next year have not only held up, but they've gone up in the last few weeks, up 1% since July 1st, still $279 for the S&P next year, which is 15.2% earnings growth. So Trinity, when people say the multiples are too high, just say compared to what? Because the earnings growth is going to be 15.2%. So provided the Fed does the right thing and starts that process just in the nick of time, I think we're going to hold up. I think we're going to do fine. And the one thing everyone's worried about, the consumer, don't bet against the consumer so long as they have a job. And so long as the Fed starts this cutting process, I think we're going to be able to hold the labor market together.
And earlier we dove into wholesale prices and consumer prices, but there are also a lot of events that are unfolding too, like retail sales data on Thursday and housing starts data on Friday, for example. So what do you feel can drive the markets later in the week?
Yeah, look, I think the short-term numbers, everyone knows the consumer's a little bit weak, a little bit nervous, and part of that has to do with affordability of housing, which is going to improve as the Fed starts to cut rates. Housing starts, you're going to see, they're not going to be great until the Fed starts to cut rates. But once that happens and the consumer has a light at the end of the tunnel, knowing the Fed is on their side versus, continuing to gut punch them, I think that things will move forward in the way that everyone expects, and we'll be able to see earnings reaccelerate. Margins are accelerating, so things are holding on, but the Fed needs to act fast. And as far as the data this week, it's short-term noise in the scheme of a long-term strong economy.
A lot of important points right there. Thank you so much, Thomas, for joining us.
Thank you, Trinity.
And we're back. And then I want to thank Reuters for including me in their article about the jobs report last week. Also, an update. We've had a huge run in 3M, huge run in the stock, multi-bagger in the options and option spreads. We took profits. We do think this business is going to go higher over time, but it was a lot of money in a short period of time, and every now and then you got to ring the register. We would love to re-enter this at lower levels. We do not know whether that opportunity will present itself or not, but we are, for the time being, holding on to the Solventum spinoff and may take a look at adding to that as well. But this was a win. And as you can see, this took a whole year plus to build this base. And then when it took off and doubled off the bottoms. And between the stock and options was very worthwhile. So we're happy with that. And, like Intel, like we did last year, it went from 25 to 48. We took off 2/3. We re-added. We bought more down after earnings last week, a lot more down, brought our basis down. I think now our basis is down to $23. So maybe we'll get an opportunity to do that in 3M. But if not, it was a good ride. Thank you very much. Ring the register. Moving on, we have some data here for the economic data. Services PMI turning up, so that's good to see. New York Fed Equifax and serious delinquency 90 plus days, that's moving up to Elevated levels at the low end on credit cards and auto loans. So we got to keep an eye on that, and I hope the Fed is keeping an eye on that, and will be dovish until they finally do their first cut in September. Doesn't really matter whether it's 25 or 50. Yesterday it was 50-50 chance. Today it's 35% chance of a 25 basis point cut and 65% chance of 50 basis point cut. The key is they get started and they can adjust up or down. Bank of Japan, Uchida says no rate hike when financial markets are unstable. So basically what happened was the Bank of Japan had to raise rates. You had the carry trade unwind because the Fed did not cut rates to offset the liquidity mismatch. When the Fed cuts in September, Bank of Japan will then have the green light to raise again, drain more liquidity, yen stronger, carry trade unwind, which supports our thesis for China. Japanese 2-year government bond yield, U.S. government spending falling year on year. So this is also restrictive. By the way, my favorite mug from my friends down in Dallas, Hedge Fund Tips. As always, opinion, not advice. See terms at hedgefundtips.com. There you go. Love that cup. Okay. So small caps failed to break out. They're retesting. They're going to break out because earning power is going up, and that trend is going to be fits and starts until it finally takes off, and then everyone will play catch up. Same with equal weights. Absolute same story. Default rates are declining. This is for leveraged loans. Actually, they peaked earlier this year, and now they're starting to go down with rate expectations. That's pretty good to see. Chapter 11 filings, though, ticking up. So this is kind of a mixed bag. This is very interesting from Charles Payne via Ned Davis Research. He shows since 1945, there have been 89 5% correction, 5% pullbacks, 29 10% pullbacks, 10 20% pullbacks, and 3 40% pullbacks. Well, ladies and gentlemen, we just had 2 20% pullbacks in the last 4 years, which means probably coast is clear for some time. Statistically speaking, we had one in 2020 and one in 2022. And average time to recover for these 5% pullbacks is 1.5 months. So, the market is working back up to that fits and starts. I would imagine we're going to recover it by September. But if that's ahead of the first cut, I'd be inclined to fade that strength and get defensive into the election, right around the first cut mid-September, and then build up cash to get aggressively long into the year-end rally post-election. Sentiment indicators dropped to cycle lows. I'm seeing a lot of the sentiment indicators point to levels where you want to be a buyer, not a seller. A lot of stuff got knocked down from that carry trade, the beginning of the carry trade unwind. I think there's an opportunity to step in selectively for the next few weeks if you're tactical, or just long-term and hold through the fall volatility, of course, which is more along the lines of what we do. I think if we do get the strength that we expect for the next 3 or 4 weeks, we'll probably put on some tactical shorts just to take advantage of the opportunity in September, October. But we'll take it as it comes. While keeping our core holdings and not getting determined. But the things that have reached close to our targets, or we've made a ton of money on in a reasonable amount of time, like the 3Ms, et cetera, we're gonna hit the register on some of that stuff. Global risk demand has recently fallen sharply into extreme fear territory. So again, these are periods of opportunity. Motor vehicle loans. Okay, owned and securities. Okay, relative multiple suggests that small caps could outperform large caps over the next 10 years. You think? Yes, it's time. Back to the 2001 to 2007 period and everyone lining up. Prime of strike. So this is U.S. prime rate in real terms minus small business funding rates is the highest in 20 years. And the implication is that they need to cut a lot more than the Fed thinks. We'll see. There are a lot of exceptions right now because of what happened with COVID, a once in 100-year event, but certainly keeping an eye on all of this stuff and not being a Cassandra and not being a prima donna either, but just dealing with the data on a day-to-day, week-to-week basis. You can see the 10-day gauge hit Japanese volatility was the highest since the great financial crisis and since they blew up in the late 80s. Japanese money supply rolling over. China's CPI is going up. That's a sign of recovery. So pay close attention to that. You saw the same thing off the 2016 lows and a straight up rally to 2018-19. And then the same thing, the 2020 bottoms straight up into beginning of 2022, bottomed early 2024, and now is working higher. That's a big thing that you want to see. Inflation going up, you want to see the yuan start to strengthen, and you want to start to see bond yields going up. All of those are coincident with equity starting to rip in China, and all of those are lining up with stronger yen, outflows from Japan, which was hot money from China, etc. PPI confirmed the CPI in China. Worst outflow from bank loans since March of 2020. That was during the carry trade unwind. This talks about Chinese out producing in terms of getting nuclear energy capacity. That's a big deal. Buybacks by corporate clients are nearing 2019 highs. So that's a backstop supportive for the markets, which should be part of the reason for the August, early September strength is the blackout periods are over, earnings are out, and now companies can buy back stocks with their cash hoards. Balance sheets are good, and so on. Moving right along, mid-cap ETFs recent buying spree after selling spate. So the money is starting to come back into mids. It will follow into falls. This is just a reiteration of Charles's data. 5% pullbacks occur more than 3 times a year on average. 10% pullbacks occur 1 time a year on average. 15% corrections occur every other year on average. 20% pullbacks occur every 3 to 4 years. And as I said, we've had 2 in 4 years. So we're kind of front-end loaded, and we should have some smoother sailing for a little while prospectively. Wake me up when September ends. So we should see this strength in August to early September. I think it's going to be actually going to be the sell the first hike. Also, that will be supported by election uncertainty. So I think, as you get into, I think it's September 17th, if you have strength and a lot of profits, it's time to book some, maybe put on some tactical shorts. And then mid-October, late October, because of the election, you can probably start to buy stuff in the hole and ride the money machine into year-end rally. Industrial/inventory cycle. Illinois Tool Works. This is earnings quotes from their calls. Destocking, which was a headwind all of last year, is no longer a significant factor at this point. We're going to hear from GXO on that as well. Johnson Controls. Overall, I think that for the most part, the large destocking is behind us. Guys, this is the whole theme of our portfolio. Destock to restock, whether it's Stanley, whether it's Intel, whether it's Generac, whether even it was 3M, by the way. And 3M probably has a lot more juice in it, ladies and gentlemen. It's just, when you get that kind of move in that short period of time, especially on the options, which some of the spreads we did were up 3-4x, you gotta hit the window, and we may revisit that one. In the meantime, we'll hang on to Solventum for the time being. ARM Holdings. That's a different business. That's Cognizant. Microsoft, that's tech. Meta is tech. Tech. Okay, so that's all tech earnings. Mondelez says they make Oreo cookies. Consumer incomes are rising, which helps to reduce the inflation-driven financial strain on many households. As a result, private label growth in our categories is decelerating, while branded share growth is improving. That is fascinating. That goes against the common narrative. Here's Marriott. We're seeing a stronger performance in the upper chain scales than compared to our lower chain scales. That's more in line with the narrative. MGM, which is casinos, majority of our customers, the middle end to high end are still pretty strong. Still visiting quite a bit. The lower end of the database has seen a bit of softening. Procter & Gamble makes Tide. So from a consumer standpoint, we generally don't see the dynamic of consumer pressure that some are describing. If you look at a couple dynamics, private label shares as an example, which typically would be increasing during the time of significant consumer pressure, that's not what we're seeing. Fascinating. Okay. Matt Serminaro from Fundstrat says a peak in put call has led to intermediate term lows in equities. That's what we saw early this month. So now we're fits and starts working back up, just like we saw in past instances. High yield credit spread yields blew out. They're now coming back in. So that's positive. Markets are again pricing more Fed cuts in the next 12 months. We find no evidence that Hurricane Beryl in Texas contributed to the rise in temporary layoffs, but summer auto plant retooling shutdowns might have contributed. So what they're trying to say is that the labor market is not cracking yet, and Claudia Sahm of the Sahm Rule has been out saying similar stuff. She's saying, pay attention, time might be different, but you got to act soon is effectively what she's saying. So maybe it's the auto retooling, and maybe it's also the immigration, which we're going to see some data on here. Other indicators suggest layoffs remain low. Bank of America credit and debit card spending per household decreased by 0.4% year on year in July. So there's some weakness there. Okay, we did the inflation. It's been the second longest manufacturing recession in history. So I could see a situation where you have some softening for a little bit while manufacturing has been in a recession, and we did have that technical recession, 2 quarters of negative GDP growth in first and second quarter of 2022. They just didn't label it as a recession. It's like a double dip recession, just like we had during the Volcker era, and then we had 18 years of prosperity. I could see a situation where manufacturing starts to reaccelerate, and that kind of offsets a customer that's taking a breather, a consumer that's taking a breather. Although we're going to see from GXO earnings that the Christmas holiday season, based on stocks, seem to be looking certainly better than last year and more normalized. So I wouldn't count out, what I always say is don't count out the U.S. consumer if they have a job. And the question is whether they have jobs, and that's going to be a question of whether you believe the most recent jobs report was what to expect moving forward, which means we are weakening dramatically, or if it was a one-off from auto retooling and from the immigration spike. Number of immigrant visas has continued to rise. You can see it there. Household debt outstanding as a share of GDP is down over the past decade. So the consumer has deleveraged tremendously since 2009. Household balance sheets still in good shape. Financial obligations relative to incomes are staying low by historical standards. Hasn't been this low since the 60s, maybe. This chart only goes back to 1983, so that's positive. Personal bankruptcy filing rates are hovering over multi-decade lows. So, you see a lot of people showing these 2-year charts, and it's like, oh, they're going through the roof. But if you go back, 50 years, they're way below normal average. Share of loans in foreclosure remains very low at 0.46%. Housing affordability index remains at record lows. This is the worst it's been since the Volcker era. Economic surprise index, Citigroup economic surprise index turning up. This is a key one. The election year seasonality is kind of going according to plan here so far. We did have that correction in late July, early August, and then it should bode well for strength into mid-September, and that's right around the first Fed cut, which historically has been sell the first cut, weakness into the end of October, just before the election, and then year-end rally. I think that's going to be the model. Now, can it be that easy? The answer is no, but it's a good framework, and then you adapt based on how things play out in real time. But That's our base case at the moment. You could see how extreme things got here at macro charts off his core risk model and bouncing off those lows. Do we go retest those? I don't know if we do or we don't, but that was that. Money market assets, these, as rates come down, once you get the first cut, a good slug of these have to come back into the market, just like they did in 2020. Half a $1 trillion came into the market pretty quickly once they backstopped the corporate credit market. I think the same will be true once you get your first 1 or 2 cuts. We'll get probably a $500 billion in for year end into equities as people lose out on short rates coming down. This is going to be the most important chart we cover today with U.S. sell-through on autos. Pretty excited about that. I went to see Cooper Standard at JP Morgan last Thursday and saw the presentation, talked with the people, and I'll share some thoughts on that as we get to the article of the week. Japanese yen, we've covered enough of that. Hedge funds boost bearish commodity bet. You're seeing Comstock resources start to rip the last few days from $8 to $10. I love when hedge funds get this bearish on commodities. I think there are probably opportunities in energy. I think there are a few Ask Me Anything questions there, but for my money, I still like Comstock is the play. Commodity cycles, boom bust cycles, deviations from the trend. So you can see here, it's coming out of the lower trend. Why did I want to? It's coming out of a low and checking back just like it did. This is a good framework model for what we're seeing. You had this low and then a rally and then check back and then a multi-year rally. And I think that's a reasonable framework. And again, what does that point to is 2001 to 2007. I think it's a similar situation over and over. We keep seeing very strong similarities of all of these things. No one's buying calls. Everyone bought puts in the holes. Therefore, they had to get smoked, and they did. Thank you for playing. Try again. Election year seasonal pattern, 1968 versus 2024. And the reason Jeff Hirsch is pointing this one is because LBJ left office, and then you had a mid-July correction ahead of the Democratic convention, and then you had this year-end rally. So this would imply that you don't get any major weakness in October, meaning it's just straight up into the end of the year if past is any prologue, which is why, only on things that we've seen huge multi-baggers would we raise cash, certainly on the option side, and then the underlying stock has to be up 50, 75, 100%. And then we'll see what things look like in mid-September is what I'm trying to tell you. There's a lot of different analogs we can follow. The key is we're intermediate term bullish. Economy's good. Earnings are good. 10.8% earnings growth versus 8.9% estimated. 15.2% estimated for next year. GDP now at 2.9%. Things are humming along. Biggest number one tail risk people are saying is a U.S. recession. That's if the Fed screws up, which they're fully capable of doing. But I think there's enough pressure and precedent and transparency now that I think they've got to go in September. And I think they've got to talk dovish in. I think their best play is, if they're being cautious, talk like a crazy dove in Jackson Hole and then only give 25 basis points in September. And then if you're wrong, you can always move in November, or you can go to like a 75 basis point in December and signal that in between, and then the market will price it in ahead of time. European relative to 12-month US forward PE. This is pretty interesting. So the European PE, doing a lot of talking, is 35 to 40% lower than the US PE. And we're going to see in GXO's earnings that demand in Europe and UK, which is where most of their business is exceeding the US. They're seeing a little softness in the US, but they're seeing a lot of strength in Europe. And you can buy it at 30 to 40% lower, which is why we have that UK play in serious position in GXO and a tiny position in ASOS, which we have yet to find a reason to make into a real position, but we're keeping an eye on it and looking for some more opportunities in Europe as well. This is the chart I wanted to show you. Immigration adjusted unemployment rate is lower. So remember, this shot up to 4.3, but if you back out the aberrational immigration, it's still down at 3.6. And this is the delta between, are we going into a hard landing with the SOM rule, or is this time different because of this immigration, artificial immigration spike, which leaves us at 3.6%. And that's what you have to keep in mind. Be data-based and be flexible. Inflation expectations basically down to 10-year lows for 3-year inflation expectations at, 2.3. Chinese government bond yield started going up. That's very positive. China goes to new extremes in crackdown on bond market frenzy. We want to see this go up, 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 along with equities. We'll cover that in the fund manager survey, but basically you're seeing sentiment levels at the levels you see closer to bottoms, not closer to tops, which is positive. The gap between mega cap tech and others is shrinking. Profit growth for the Magnificent Seven starts slowing. Rest of S&P hits its stride. We've been talking about this for months. Now you can see it happening. Net income growth went from 50%. Now it's down to 25% and going lower. S&P Magnificent Seven net income growth now starting to move to high single digits from being negative up until last quarter. Fed is featuring on earnings call like never before, so that's becoming a major issue. Just like it was back here, it spiked in 2000 and late 2008 when they finally started cutting. Investor sector allocation, so they've gone into defensives. Pharma, and they're out of discretionary. There'll be some opportunities to pick up there. You saw it in Starbucks, by the way. We've talked on it. The reason we didn't get involved in Starbucks or Nike yet, and we continue to keep our eye. We'll probably miss it with Nike. You're gonna wake up and there'll be an activist in Nike, and we'll miss it. And Lulu for that matter. Maybe we'll get one of them. It's just a question of what do we want to sell. Well, we did take off 3M today, so maybe there'll be a new spot in the portfolio. Was just because they had meaningful China exposure, and we have a meaningful China exposure through BABA, so we didn't want to have a high correlated trade. But we're going to be open-minded because there's certainly opportunity there. The other thing I thought was silly was Nelson Peltz. I don't know what's happened to him since Ed Gardner left, but he's become like a day trader. Like Disney spiked up and the guy sold it, partially because they didn't let him on the board. Then he gets in Starbucks, it spikes up 20% and he sells it. Are you telling me you put billions of dollars in a position to make a 20% gain? Are you like a day trader? Like, why would you ever take that big of a position for a 20% move? Like, it makes zero sense to me. So I'm not sure what's going on over there, but after Starbucks spiked, he got out, which tells me his level of confidence in the position, which also tells me maybe there'll be another chance to get in. But I think that's going to be a harder ship to correct. They couldn't have picked a better guy to do it than the guy from Chipotle, but I think it'll take some time, and after the honeymoon is over, maybe there'll be new opportunity. But I really don't want to compete with Luckin in China. So for me, certainly with the last CEO, it was an absolute no. With the new CEO, it's a maybe, but I'm not paying up for it. So we'll keep an eye on that one. Lower bond yield expectations back to 2023 highs. So the last time they had the lower bond yield expectations at this level was November 2008, which started a huge cutting cycle. Expectations for lower short rates highest on record, going back to March 2020, which was the bottom of the market as well. PPI, we saw VIX has rolled over. Recent immigrants' labor force share has risen sharply, and their unemployment rate has also trended upward, which has skewed the overall, which is what we were talking about on the earlier part. We estimate that net immigration into the U.S. reached 2.9 million people in 2023, 1.9 million above the pre-pandemic trend, will slow to 2.2 million in 2024. This is the percent of companies with positive 12-month percent changes in forward earnings. This is not the stuff you see at the end of a cycle, ladies and gentlemen. This looks exactly like the previous cycles. You get the huge spike off the lows after the recession. You should have a recession line here in 2022 because we had 2 quarters of negative GDP growth, and then it rolls over, and then you start the recovery. It rolls over, start the recovery. Rolls over, starts the recovery, or in the case of 2009, rolls, spike off the low, then a check back, and then you continue higher. Spike off the low, check back, continue higher. But that's what we're seeing right now. This is not what we see at tops, is all I'm trying to communicate with you. That's the seasonal pattern. Some updates on the news in no particular order. Chinese stocks get upgraded as bear market risks seem tempered by state buying support. Canadian research firm says Chinese stocks in good stead, and they're pointing to the Japanese hot money flows coming out as well. Bloomberg Intelligence predicts Alibaba and other dot-com giants to announce more share buybacks. Disney stock falls after downgrade. 2 things going wrong. What's going right? It's so funny when you click. They change these lines dynamic. They change the headlines dynamically based on what the stock price is doing intraday, which is kind of comical. It's like they completely blow with the wind, but I guess that's what you have to do in that business to stay alive. And we'll talk a little bit about Disney, but this analyst took the price target down to 225. So everyone's worried about the park slowing down for a couple of quarters. They released a whole bunch of new stuff over the weekend, which we'll talk about. But the big story, if you remember, most of the reason we got in, parks are great, highest return on invested capital, but ValueAct is the activist in this stock. And ValueAct turned around Salesforce, it turned around New York Times. If they could turn around New York Times, they could turn around anything. They made New York Times profitable. They turned around Spotify. So those were the 3: Salesforce, New York Times, Spotify. And they did it all through pricing bundles and increasing the prices. And as you saw, which the market didn't respond to, they raised the prices right before earnings, and they're going to add the ESPN to all the bundles. All of that business is being valued at 0 right now. It's got 153 million subscribers on the Disney Plus part alone, leaving aside ESPN, which is the #1 franchise in sports, gaining share, not losing share, and they're going to monetize that through streaming. And so if it's half what Netflix is valued at, 300 billion for 277 million subscribers. They've probably got 200 across platforms. They're valued at 0. I'm gonna take a wild and crazy bet that it's worth more than 0. Disney Plus, Wolverine, Inside Out 2, both billion-dollar franchises, theatrical releases, Disney, Hulu, all that stuff. And let's just assume it's not worth half of Netflix. Let's assume it's worth a quarter of. At the end of the day, it still takes the stock between 150 to 200 over the next few years. And that's what we need. The options will be a lot, the stock will be a double. The options will be multi-baggers, and we'll be ringing the register like 3M in no time. No time was a year and a half. So there you go. Retail investors haven't been this pessimistic in 9 months. That's the periods that we like to be looking for opportunity. PayPal stock rises. It's fast track to better margins with new guest checkout system. We've been talking about this for months. 80% conversion at checkout versus 50% the competition, which means you can charge more because you'd rather pay, 200 basis points on an 80 or 90% conversion than 100 basis points on a 50% conversion. Just do the math if it's a $100 ticket, and that's going to increase margins, increase payment volume, increase earnings, increase cash flow. And as we covered before, they said, oh, by the way, we're not going to do $5 billion in free cash flow this year. We're going to do $6 billion. Oh, and by the way, we're not going to do $5 billion in buybacks. We're going to do $6 billion in buybacks. Oh, and by the way, do you remember just a quarter ago when he had that really conservative guidance, and I called him sandbagger in chief? Well, this was evidence of it this quarter. As you see, he's already blowing estimates out of the water. He didn't even wait a quarter to keep us in suspense. He just, the foreplay is over. I mean, we're getting down to business here. This guy is rocking and rolling. So Disney raises streaming prices for Hulu, Disney, and ESPN. If you remember, the guy Alex Christ, the new CEO, he ran the small business division at Intuit. The stock was a 28 bagger plus while he was there, and he was responsible for 50% of the revenues. This guy's going to do it. He's already doing it in just, he's basically just found the coffee machine. He's only been there for 3 quarters, and it's off to the races. Yum China gobbles up gains. State Council prepares service consumption policy. China's CPI went up. It's starting to improve. That's a sign of recovery, not decline. Freshippo, which is could be the Costco of China, which we own through Alibaba, achieves 4 months of profitability after major restructuring. So all these things are turning around. Intel stock may have bottomed at tangible book value. That's from, we posted over the weekend from Barron's. Why am I not signed in here? And tangible book value, just for you guys that are new to this, is basically what you get when they liquidate the whole company. So you're basically trading at liquidation value. I like opportunities like that where your downside is covered and your upside is unlimited. And we like this story. So we covered it last week. We did about an hour and a half on it. Go back to that podcast and listen if you're interested. Why Buffett's dumped 55.8% of its Apple stock? Well, one reason could be that it's historically traded at a 14 times multiple. Now it was at a 28 to 30 times multiple. Oh, and by the way, the earnings growth expectations have halved. So you're paying, twice as much for half the growth. Other than that, how is the play, Mrs. Lincoln? From villains to Indiana Jones, everything we learned at Disney's Parks Panel 2024 D23 Expo. That's a mouthful. So they're going to do a Villain Land coming to the Magic Kingdom. For all the evildoers out there that like to go to villain parks with their kids, have at it. They're doing more cruise ships. They're basically laying out all the things that they're going to invest in and how it's going to be great, and they're not asleep at the wheel, and we know all that stuff. China goes to, otherwise we wouldn't be owners. China goes to new extreme and crack down on bond market frenzy. Go after it. It's time you get off your butt and turn this ship around. Baxter to sell its kidney care business. So they got $3.8 billion. Going to use $3 billion to cut down the to sell off their debt. They were originally going to spin that to us. That's a low growth business. So the fact that they're getting rid of it, number one, I don't know if we would have hung on to that spinoff, to be honest with you, the kidney dialysis business. We usually really like spinoffs like Solventum. So I'm glad they sold it. They'll take the debt down by $3 billion, which is going to take down their interest costs. Oh, and by the way, because they don't have the slow growth of the kidney business, their multiple is going to get re-rated from 10 to a normalized 15 over the next few months. And their free cash flow is going to go up because they have less interest payments for debt service, and they've got a lean, mean, money-making machine. So we like this. We're very excited. No change in outlook. And there you go. Stock down 54%. Is it time to buy the dip on this growth stock, which is GXO Logistics? Amen, baby. You're preaching to the choir. We're going to talk about that one in the article of the week. Alibaba's Lazada posts first monthly profit amid intense competition in Southeast Asia. So they turned that profit around from losing money to making money. How China, just like they did with Freshippo, how China stocks could break out of the value trap. So this guy put out this chart which shows the CSI 300 versus estimated EPS, and what he's basically saying is every time it got this extreme, you got a huge rally in equities. We know the story. It's time. China expects air travel to hit a record in 2024. Amen, hallelujah. China delivers another harsh verbal warning to bond buyers. There you go. So look, if you want to get people out of your bonds and into your stocks, start buying more stocks, and when the price goes up, the opinion will follow trend, and then you get some natural buyers. The stock market could double and it would still be cheap. So you want to solve your problem for any of the Chinese policymakers that are listening to this, do what Japan did, start buying equities, get a bid in it, opinion will follow trend, and then you'll get a normalized multiple, and then the game will be on like you saw in Japan. The difference is you've got 5 years of supportive demographics before you fall off a cliff. Japan does not. So that's why Japan hot money is going to come out, and it's going to come into China once the Chinese policymakers get with it and realize there's an opportunity sitting right in front of them. Home Depot stock bounces as home improvement demand may have just bottomed. So that's good to see. Everyone had been negative. That's all going to be a function of rates. Stanley Black & Decker is going to be a function of rates. Generac is going to be a function of rates. As much as they've both already rallied, they're just getting started. Wells Fargo strategist says investors may face a 1995 rerun once Fed cuts rates. We agree. Mid-cycle cut, massive rally. Just get it done on time. And then the Fed Whisperer, who I was on Liz Clayman's show last week with Nick Timiraos, says basically the CPI report this morning clears the low hurdle for a September rate cut. So game on, basically from the horse's mouth. The article of the week just published a couple minutes ago, so I'll be able to check for spelling errors in real time. Restock cycle, stock market, and sentiment results. That's probably the lamest title I've ever done, but I couldn't figure out anything to rhyme with restock. So there you go. Last Thursday, we did that. Okay, wanted to do this update on Cooper Standard since going to the presentation at JP Morgan last week on Madison Avenue. And what was exciting about this is there wasn't anything new other than the fact that they talked about what they're seeing in terms of incentives in the market picking up, and that they've been following this for decades because all these guys are lifelong auto industry people. And, you know, I have indicators that are pretty much guarantees in my work, and they have indicators that are pretty much guarantees in their work. And one of their indicators is when incentives from dealers and manufacturers start ticking up, volumes quickly follow. And I'm going to explain how that's counterintuitive in just a minute. But let's go to this chart to start with. As a reminder, in 2018, the national sell-through was 18 million units of vehicles in the US. So that was right here. November 2017, 18 million units. On that basis, Cooper Standard did $7.22 a share in earnings. The stock traded at $146. So you basically had a 20 times multiple on that earnings power. Let me move ahead here. Last week, we went into detail on Cooper Standard earnings, outlooks, and prospects moving forward, as well as our original thesis from May 22 when we initiated the position around $5.50 a share. You can find it here. So click there and read the whole thing, and then click on the link in that article that goes to our old articles from May of 2022. One concept I wanted to point out is that since 1980, every single cycle has peaked out at 18 million SAR. Expectations for 2024 were that the industry would do 16.1 million this year. It has since been revised down to 15.8 million. So here's 18 million. We're at 15.8. This is 18, 15.8. 18, 15.8. 18. Now, look at the last cycle. 2005, it peaked actually above 20, but it was, 18 for some time at the top of the cycle. It stays up at 18 for a few years before it rolls over. Okay, so it was at 18 from, 2006 to 2004 to 2006, basically. Then the previous cycle before that was the late 90s. It got up over 18 in 1999. Then the previous cycle before that, it got again, peaked over 20 actually, but mostly over 18 in like 1987 and 1986. And they also all trough below 10 million. In 1981, it troughed below 10 million. In 2008, it troughed below 10 million. In 2020, it troughed below 10 million. It's mind-boggling considering how much the population has grown. Leaving that aside, if we know that it's going to 18 million for shizzle, as Snoop Dogg, the Olympic MC, would say, then we know that the question is, if we know what the industry volume is going to be, whether it's 2 years out or 4 years out, then we can back into what can Cooper Standard earn on that, and then what will the market pay for it. So you could say, well, that's very easy. Well, if they did 18 million in 2017 and they earned $7.20, then the stock could be $140 again, or maybe if it doesn't get a 20 times multiple, maybe it gets a 10 times multiple, it could be $70 again. Well, that's good. We bought it at $5.50. It's at $13. Any new money that comes in, we're buying a ton at $12 and $13. We're super happy to add at these levels, super cheap. Now, one of the key factors, which is a leading indicator of volumes, is incentives offered. In recent years, the OEMs have experienced the halcyon days of controlling supplies and selling above MSRP. With a wink and a nod, all the OEMs followed suit until now. As inventories build, partially due to the artificial EV push that was not met with natural demand, incentives are starting to accelerate, meaning there's cars on the lots, they got to move them. This is the key leading indicator of increasing volumes to come. To the layperson, one would think that they are increasing incentives because no one wants to buy cars, therefore volumes will fall. The opposite is true. The high rates, high prices, and low supply has led to pent-up demand, with average car on the road now over 13 years old, which is a record high. The Korean manufacturers will continue to ramp lower cost alternatives, forcing the US and Japan OEMs to follow suit and offer incentives to move their current inventories. Take a look at this chart. This is the average age by vehicle type. You can see here passenger cars at 14 years old, light trucks at 12 years old, combined at 12.6 years. This will hurt OEM margins, GM, Ford, Stellantis, Toyota, Motor Corp. So to make up the profits, they will have to produce more volume to meet profitability goals. If they hold out for price, meaning they're unwilling to cut, they will lose meaningful share. The race to the bottom will be on. This is good news for the consumer, good for auto suppliers that benefit from volumes, and less so for OEMs. We don't own any OEMs. Our play is for volume through Cooper Standard. So what could this actually mean for Cooper Standard? Forget about what it means when production peaks at 18 million several years out, like every cycle for the last 45 years. Just a move from 15.8 million SAR, where we are now, to 16.1 million will have a massive impact to earnings per share due to CPS operating leverage. We estimate that another 300,000 cars could yield $50 million straight to the bottom line. That's on 17 million shares. So given how efficiently CPS is now running, that implies $3 a share in earnings, approximately $3 a share in earnings. As a friendly reminder, when Cooper Standard was bloated and running inefficiently in 2017, the stock traded up to $146 a share on $7 a share of earnings per share at 20 times multiple. Historically, when profitable, CPS is traded between a trough multiple of 10 times and a peak multiple of 20 times. So if we can go just to 16.1 million SAR and earn $3 a share at 10 to 20 times multiple, 3 times EPS times 10 or 20 times multiple, equals $30 to $60 per share price. What could the business do on a peak SAR of 18 million a few years out? The answer is a lot more than it did on 18 million SAR in 2017, because the margins are better and the cost structure is rationalized. An assumption of $3 a share for every 300,000 additional SAR after 16.1 million might be too optimistic, but what if we cut that in half? I don't think it's too optimistic, but let's just cut it in half. $1.50 more EPS per 300,000 cars from 16.1 million to 18 million equals 6.33 times 1.5 equals $9.50 a share EPS, plus the $3 from 15.8 to 16.1 equals $12.50 a share EPS, or 75% more earnings power than when it traded at $146 a share. There are no guarantees in anything. There's always execution risk, market risk, unknown risk, etc. Hedge fund tips. Opinions, not advice. See terms. That said, no matter how conservatively you continue to cut it in half, the potential upside, you still wind up with a very attractive risk-reward profile, which is why we've continued to add shares along the way. Just as we rarely buy 100% all at once, we rarely sell all at once when we'll be taking profits all the way up. To be pessimistic, you have to take the view that less people will buy cars when the Fed lowers rates and the prices come down, and less people will buy cars when the average automobile ages past 14 years old. I'm not willing to take those bets, which is why we have such a material position in Cooper Standard. Here are rate odds cuts for September, which, for those of you who are not good with math, is about a month away. This is 2/3 odds of a 25 basis point cut, 1/3 odd of a 50 basis point cut, and 100% odds of easing. So those are good odds. Bank of America Fund Manager Survey update. On Wednesday, we put out a summary of the monthly Bank of America Global Fund Manager Survey. This month, they surveyed institutional managers with 500 billion AUM. Here were the key points. You can check out the whole summary here. Number one, the most number of survey participants in 16 years believe monetary policy is too restrictive. The last few peaks in this level of too restrictive belief marked at or near bottoms to buy cyclical small cap dividend payers and international stocks. With the Fed funds rate greater than 200 basis points above inflation, we concur with this point of view. So here are managers saying you're too restrictive, and what happened after each instance. Number one, the market bottomed, and number two, the Fed cut. Number two, sentiment is climbing the wall of worry, but not at extreme levels. So this is not the type of sentiment you see at tops. It's more like the sentiment you see near bottoms. Utilities exposure has skyrocketed to 1.4 standard deviations above its long-term average. You remember last year we were pounding the table by utilities when no one wanted them. They're up 50%. Now everyone wants them. I think it's probably sold to you time. Long Magnificent 7 is still the most crowded trade despite a recent 18% correction. So there's probably a little bit more pain there from some spots. Managers' outlook pessimism on the economy mirrors levels you see near market bottoms versus market tops. Investors who see stronger global economy in the next 12 months. This is what you saw in 2009, huge rally. This is what you saw at the 2020 lows, huge rally. All right, GXO Logistics update. Here are the highlights. They had 19% revenue year over year, but that was because they closed the Wincanton acquisition in the UK. They're going to have $50 million of synergies out of that one. 2% organic revenue growth. $270 million in new business wins. Sales pipelines increased to 12-month high of $2.3 billion. On track to sign up a record amount of new business this year. Sequential improvement in organic revenue and strong free cash flow. Reaffirm their guidance and strengthening consumer demand in the UK, which is 50%. They generated $115 million of cash flow from operation compared to $61 million year on year, and $31 million of free cash flow compared to $3 million. They're guiding at 30 to 40% free cash flow conversion on 800 and call it 20 million adjusted EBITDA. So call it 300 million of free cash flow back end loaded, which is usually in line with their seasonality. Also in line with what they're seeing regarding inventory levels for the holiday season, which are much better than last year, which was disappointing. The restock cycle has begun. They did adjusted EBITDA of 187 million this quarter and operating cash flow of 115 million. You can see that. You can see the recent wins and expansions from Levi's is a big deal in Germany. They're getting some of the industrials now, Raytheon in UK, Boeing, Carrefour, WH Smith, Trindle, etc. And then their wins came from 21 from competitors, 32% new activity from existing, and 47% came from clients that were outsourcing their supply chain management and logistics outsourcing to GXO, which is a trend. Why? Because your margins increase when you outsource that business, and that's a good thing for earnings, and that's a good thing for CEO stock options, and they all want to do it, and that trend is going to accelerate in coming years. So you can see the revenue growth here. You can see the return, operating return on invested capital was 32%, 2% above their target. Net income to average invested capital was 13%, and then cash flow from operations we covered. As it relates to the earnings call, this was a big deal. He says, the CEO says, Malcolm Wilson says, as we've mentioned, we believe we saw the bottom of the inventory cycle in the fourth quarter of last year. We're beyond that inflection point, and we're seeing volume trends beginning to improve. E-commerce has returned to a sustainable structural growth. About half the contracts we signed this quarter were from newly outsourced activities. We acquired Wincanton at an attractive valuation. 2027 targets of $15.5 to $16 billion of revenue and $1.25 to $1.3 billion of adjusted EBITDA, which is 30-40% free cash flow conversion, $500 million. I mean, and I think their free cash flow conversion will actually accelerate as you get that far out. So that gives you an idea there. All right, definitely. Okay, so in the Q&A, he says, definitely UK and continental Europe, they've remained stronger. That's about 2/3 of our business. Not yet seeing that return to growth in North America. Still a little uncertain. What we're seeing is tremendous amount of new business activity. In fact, we signed more new business in our North American business recently than for a long time. I think we're on target for a record in our North American activity for new business signings. So inventory levels also, we definitely started to see those return. So from that low point of the end of last year, I think that was really the inflection point for inventory levels across all regions. Definitely we're seeing inventory levels come back. Customers already starting, I think, to prepare for this year's holiday season. Sales have been strong. Sales pipelines really strong. Deal sizes getting bigger. Duration of contracts getting bigger. Continental Europe, UK, we feel the business is very good trajectory of growth. North America, still a little bit uncertain, but we do see the signs of an improving situation later in the year, not least the fact we've got the holiday season ahead of us. This year's period will be better period for us than last year as far as it relates to the holiday season, free cash flow, blah, blah, blah. As you would recall, our cash flow trends tend to be second half tilted every year, so our guidance is reflecting that. Fear and greed index down to 26, up from 21 last week. So there's still a lot of fear in the market, which creates opportunity into that first cut. And then economic data, we covered the PPI and CPI were the big deals. You have the CPI today came in at 0.2%, which was in line with expectations. Year on year came in at 2.9 versus estimates of 3.0, and last print was 3.0, so that was better than expected on CPI, also better than expected on PPI at 2.2 versus 2.3, which is the leading indicator for CPI, and month on month was 0.1 versus 0.2. All the other numbers don't matter. Earnings, as we covered, better than expected, 10.8% versus 8.9. But the most important thing is guidance has been revised up by 1% since the beginning of January, still holding in at 279 for next year. So the podcast is over. We're going to go into the Ask Me Anything questions from our listeners. For everyone who likes that, please stick around. Gasper Mahark says, hi, Tom, big fan of the podcast. I'm with you on PayPal, Baba VFC. Was wondering if you are maybe looking at WBD in light of a recent drop. Management is selling it as a turnaround, but it seems to be a grind. Any thoughts? I'm not going to get involved in that. We've looked at that 3 or 4 times in the Ask Me Anything question. Zaslav is pulling $40 million a year in salary and destroying the company. I think there is value there. I don't want to be involved with it. I think it's got too much debt. I know it's got free cash flow. It's just too hairy for me at the moment, so I'm going to pass. And I don't want a correlation. Disney, I've got a margin of safety because I got the parks, I got everything else. So I'm happy with Disney. I don't need to play in the gutter with Warner Brothers. If it works, it'll be a triple, quadruple. If it doesn't, you got a goose egg. Not interested in that. Disney, if it fails, I'm down 20% for a little while. If it succeeds, I'm up double, and my options are up 3 and 4x, and that's highly probable. So Jim Jones was wondering about Comstock. Yeah, the reason the share count increased is because Jerry Jones put up a lot of equity for the company to ride out the shorter term thing. once the free cash flow kicks on as natural gas prices, they'll buy in the stock and it'll be back to the races. I still like it, and that's basically what it was, and we're comfortable with that. Conrad Voigt, and that's very common in those E&P companies also. Their share count expands and then it contracts once the cash flow spigots go through the roof, because they don't do so in a linear fashion. They do so in a parabolic fashion. And when the cash gushes, they just buy in all that excess share count and it just goes to the moon. And it's trading not only nowhere near proved reserves, it's trading nowhere near unproved reserves as well, even at these depressed prices. Tom, a student and listener from Germany. This is from Conrad Voigt. Thanks a lot for the great insights on your podcast. You recently talked about small caps outperforming over the next 3 months. How would you design a potential trade on that? Russell ETF or options? Do you have any specific stocks in mind? Yeah, I got one. It's called Cooper Standard. But you could buy the ETF, which is IWM, or others that are small cap exposure if you wanted to play it that way. We prefer individual small cap stocks. JP Ding, people often ask about when you know when to leave a trade. What about when you're too early? I don't mind being too early. I'm probably too early on 3M, but I'm happy to ring the register. I thought I might have been too early on Intel last year at 48. I think I was, because it went to 51 and then it crashed down to 29. And then we just had this debacle last week, which it went down to 18 or whatever it went to. Now it's back to 20. And we rebuilt the position we sold at 48. So, you know, I know where I'm getting out before I get in to 99% of the positions. The only thing that would change my mind is if the fundamentals got so outstandingly better than I anticipated. Then I would consider staying in longer than I anticipated. But that hasn't happened yet in 3M, and that I think long term it will. But every now and then you got to ring the register. You can't just ride everything up and back down and back up. You got to, you know, hit the register, and if it goes against you, maybe rebuild the position, and if it goes away from you, like, so what? I made a multi-bagger on the options, made a lot on the stock, and on to the next. Cooper Standard, May 2022 looked great, but also looks like the stock won't meaningfully move until car volumes and free cash flow comes back meaningfully in second half 2025. So do you just prioritize other opportunities and wait on putting new capital in CPS as it's likely to flat down? So, like, when did you have the crystal ball? Like, how do you know when volumes are coming back? 6 months ago, they thought volumes were going to be 16.1. Now they're 15.8. How do you know 3 months from now they don't say 17? You know, after the Fed cuts and you get all these people rushing out for Christmas. You just don't know, is the answer to your question, number one. And number two, they didn't elect cash pay on the debt versus PIK because they're fearful that things are going to be going poorly. These guys are dialed in, and when they see what's happening with incentives and they see what's happened every other cycle, they know what's going to happen to volumes, and they have a better finger on the pulse than we do. So I don't care. Look, I went through that BYD trade that Charlie Munger did that had like 50 to 70% drawdowns before it went up like 12x in 1 year. So he couldn't know when that was going to happen, but it didn't matter because the CAGR over the 20 years was like 20-something, 25%, because he stayed in. Why? Because he didn't have leverage. So if you're, jumping around looking for the next best headline and noise, you're going to miss all these opportunities. So for me, no, I'll just use the flat opportunity to put more money to work when I'm able to, or just sit there patiently. This is the business that you get paid for inactivity, not activity. The reason most people lose is because they have to jump around and chase the next shiny object and get their faces smacked. The people who make money in this business are patient and probably golfers because they know how to just step away if they've done the work and they know what they own. It's funny. I was talking to a friend, and I had the worst round of since last year this weekend. And the weekend before I had a great round, qualifying for the club championship first round, and I was like kind of whining to a friend, and he's like, it's like, you don't mind volatility in stocks. Why do you mind volatility in your scores so much? I said, because with stocks, I'm 100% certain of the underlying fundamentals. I have no problem with that. I know they're going to work out. At golf, I'm probably 70% sure of my underlying fundamentals. So that's the key difference here. So the answer to your question, JP, is you do what you want, but I would never sell a share of that right now because I think it's going to take another year. Because when it goes, it's just going to go overnight. And, you're going to wake up because you sold at 9 and it's 25 and then it's 50 and then you buy at 50 and it pulls back to 25 before it goes to 100. And you're just going to get it at all the wrong times, 100% guaranteed. Patrick K. That's why you have a basket. That's why we run a basket of 8 to 12 companies. It's the same framework across the board. Some pop immediately in a year. Some take 6 months. Some take 2 years. Some take 3 years. Some go against us before they turn. Some take longer than that. But on balance, we're going to get our doubles and double pluses over a couple of years, and we're going to keep rinsing and repeating in aggregate. And the ones that take longer wind up making more in the long term, and the ones that go faster wind up being shorter. But if your framework is correct, you will make money and you don't have to worry about this nonsense about timing and being impatient and everything else. And if you're impatient, go become an entrepreneur, because entrepreneurs get paid for activity. You can take action every single minute of every single day, and the more action you take, the more money you make. In this business, it's the exact opposite. The more action you take, the worse you're going to do until you absolutely blow up your account. So less action with a good framework is how fortunes are made over time, and low leverage. Patrick K. Thanks for the valuable time and effort you consistently share with us. You're the real MVP. Thank you very much. Questions related to home builders. I have no position in either direction. I've had a nice rally. I've been pounding the table when everyone else was in the hole. Mortgage rates falling. Potential unwind of the locked-in effect a concern for home builders, or is the supply imbalance too vast? Look, rates are going to come down. That game is going to be back on. I haven't found anything that I want to buy yet, but I'm keeping an eye on it. Ben Russo, I'm actually comfortable with the derivative plays. I've already got my exposure through Generac and Stanley Black & Decker, so I'm good there. Ben Russo, hi Tom, thanks for all the information lessons you put on impart on the regular. Could you please take a look at AMR, focuses buybacks, and NVR. All right, let's see. AMR. A miner. Why do you keep sending me these crappy miners? All right, so you want me to take a look at a stock that's up 450x, and now you're interested. I'm going to tell you before anything, I'm not interested. I don't even have to look at the numbers. So, number one, based on this pick, welcome to the podcast, and I hope you will stick with us for many months ahead, and you're going to learn how to do a great job. What the problem I see here, Ben, is that cash flow peaked 2 years ago. It's collapsing. Revenues are rolling over. Return on capital, margins are rolling over. I want nothing to do. This is a stock that's up 400x and is rolling over on every single metric. I mean, this would be probably something to short, to be honest with you, but I haven't done enough work, number one, to do that with conviction. Number two, if I was going to short a particular stock, I would never speak about it publicly, and I'm not going to short this stock. So, but I'd just say if I had to do something, it wouldn't be long. Let's just put it that way. But I'd need to do a lot more work either way. But thank you for tuning in. And what was the second one? NVR, you wanted me to look at a home builder. All right, so this has been a steady grower for a long time. It's basically at new highs. I just wait for this stuff to pull back. Let's just take a look. This is going to trade with all of them. XHB. What is the home builders doing right now? Yeah, basically at new highs. Now, if you didn't buy this in the hole in 2022 or 2020, just wait. There's nothing to do with it. Play the ancillary plays that are in the hole from the destock restock cycle, like Stanley Black & Decker and Generac is our view. I know Generac's up almost double already, and Stanley's starting to take off, but I think these are basically getting going for a new cycle. Opinion on Oxy. Buffett loves it. The name's near his average. The name is not near his average because he did a warrant deal, and everyone thinks he's buying all this stock. What he's doing is converting warrants that he had at much lower prices, so everyone's following him and buying the stock up. I just like Comstock right now. If I find another energy play, I will let you guys know, but there's nothing that's standing out for me yet. So with that said, I want to thank everyone for tuning in. We will be back next week, hopefully at the right time on a Thursday instead of a Tuesday or Wednesday. But in the meantime, make it a great one. Bye for now. Thanks for tuning in.